investors continue to weigh the economic impact of the spreading outbreak and its impact on safe haven commodities. Mark Hayfele of UBS Wealth Management told Bloomberg he thinks gold could finish the year strong.
One thing that our clients are looking at, however, is gold, and we think that gold could finish the year at 1,600. It's not necessarily something that we want to add to our long-term asset allocation, but I think that clients recognize that should things go completely wrong and inflation start to pick up again, it may be an asset that gives them that measure of insurance.
Jeff Currie of Goldman Sachs still with me as well. 1,600, we go higher. What's your call?
I think the risks are to the upside around that target. Our target's the same thing, but on a 3-month horizon. There's 3 key reasons to why we're bullish on gold. The first foremost is geopolitical risk hedge, and we saw Iran more recently, and the events around the coronavirus. A lot of reasons. By the way, the reason why we don't see any response out of the coronavirus. Remember, China is the largest jewelry buyer in the world, and if they're not going out and buying, you get the weakness. And so if you look at gold, has been trading 1570 and change now throughout this because you just don't have the bid coming from the physical side. So we assume they come back and buy. So geopolitical risk. The other one is the de-dollarization, and that's one of the ones that we really view as a substantial reason to own gold. You have central banks around the world right now diversifying away from dollars. Last year, they bought 750 tons of gold, represented 22% of global gold supplies, and is the highest level since the Nixon era. So that is, I think, a big key issue. Will continue to be a driver going forward. The third reason has to do with a savings surplus. You look in, economic theory says savings equals investment. Well, what are we seeing across the commodity space in the old economy? CapEx is down everywhere. In fact, before the coronavirus, we had that problem. And it's likely to be a problem afterwards. That opens up that gap and creates excess savings. And that excess savings, a lot of that's being put into assets like gold, which is helping to support gold. And that follows along the lines of the negative real rates that you have in places like Europe.
And more stimulus, et cetera, et cetera. All right, another commodity we want to dig into is natural gas. So LNG is having a very rough start to the year, and the virus fears are making it a lot worse. Global natural gas prices are drifting lower, making U.S. LNG even less competitive abroad. Well, joining us now is our Nat Gas and Power Markets reporter, Naureen Malik. It's unbelievable to see the convergence of all these global natural gas prices. What was the really big catalyst here?
Well, the really big catalyst is that the entire northern hemisphere has seen an unusually mild winter. Everyone knew that it was going to be bad, potentially bad this year. We've had an unprecedented growth of U.S. or global LNG export capacity led by the U.S. and Australia in the previous 2 years. So people saw this glut coming, but really there was hope that winter would show up and soak up a lot of this excess supply. Well, that hasn't happened. The U.S. and Europe and Asia are on track to have some of their warmest, if not warmest, winters on record. That's allowing inventories to build up globally. And now you have this booming global LNG trade. And so the threat that everyone is looking at is how quickly or how much could we see a slowdown in that?
And a lot of this is also now with force majeure, where you have China saying we're not going to take delivery of this LNG that we promised to buy because we just don't have the demand, and that counts. And Total obviously suing China in response. What does that mean? How does that work?
Yeah, usually you see force majeures like in the U.S. when there's like a pipeline outage, like maintenance problem. So this is kind of a new thing on the global market. And you saw European energy companies say, hold up, a virus, yes, like an illness is like a huge issue, but it doesn't quite meet the standard of a force majeure. So that's something that is being worked out. And Poten & Partners said today that Total, which CNOOC was going to declare a force majeure on a February 7th cargo, they managed to work that out in exchange for deferring cargoes. And we're hearing about Qatar deferring some cargoes. And so that's kind of like an early indication of like, how can that spread? Like, are you going to see more of those? And then eventually the bigger threat is, are you going to see outright curtailments, especially, everyone's really focused on the U.S. where we just have excess supply, and Permian gas is already trading at negative levels for March.
Naureen Malik of Bloomberg, thank you very much. Good perspective. So, Jeff, when you take a look at the natural gas market, what happens? Because Europe was basically the sinkhole for U.S. LNG. Now what?
It's still the sinkhole. When you look at pricing, one thing that happened in the last couple of days that we've never seen before, JKM now trades at a discount to TTF here in Europe. So if you look at where the ARB's still open. You're trading 275 here in Europe. You're trading $1.80 in the U.S. right now. ARB's still open. Where is this going to go? It's going to keep coming into Europe. And so really the question, in fact, I heard yesterday there's so much gas here that they're actually injecting gas in the middle of the winter. Combine that with the warm weather. So I think the key issue, that we're focused on looking further out towards the spring and the summer, is are you going to see the Europeans flinch? Will the Norwegians cut? They have a 40% market share. So for them, they're like a very large, oligopolistic player. And I would tend to think that Gazprom will keep pushing against, because if you are a European player, you got the U.S. LNG coming into your backyard. If there's ever a time to push it out, now's the time. And you're getting to the levels of shut-in prices in the U.S. We're trading, let's say, $1.80 right now. You got to go down to $1.10, up in the Appalachians. That, depending on what the netback is, you're talking somewhere between $1.60 and $1.80. We're in that range, but we think you probably need to go a little bit lower before you start to get to those kind of levels.